So I want to start with an example today. I purchased this company back in 2013 called Air Products and Chemicals. This is a dividend-paying company, a dividend growth stock with ticker symbol APD. Right around the same time that I purchased my initial shares in Air Products and Chemicals, an activist investor came into the mix. An activist investor named Bill Ackman. He works at Pershing Square Capital. This is, from my understanding, a hedge fund. And his company came in, they purchased $2 billion worth of Air Products and Chemicals stock, right around the same time that I did. And Mr. Ackman, he believed that APD, Air Products and Chemicals, wasn't being operated as efficiently as it could be. The value that was in the company wasn't being unlocked by the market. Anyways, he went in, he tried to shake things up. In fact, it seems like he did to an extent. The company ended up selling off some less profitable business units, ended up cutting down the workforce, and lo and behold, the stock price went up and the company flourished, at least in the short run. In the long run, we will see if these short-term actions paid long-term dividends or not. Needless to say, the performance on this stock that I've experienced has been pretty good. When I purchased in 2013, I started purchasing around $95 per share. Right now, in 2018, it's at $163 per share, so I'm up 72% just on the capital appreciation alone. Nice, I really like that. That's a good gain for a 5-year period. That being said, I don't invest for capital appreciation because I never intend to sell. I invest for dividends and cash flow. So let's look at that. The starting dividend was $2.84 per year when you add up the quarterly dividends back when I purchased, and that was a starting yield of approximately 3%. If I just take my $2.84 divided by $95, that's a 3% starting yield. Well, the dividend has increased over the years. In fact, the dividend on Air Products and Chemicals over the last 5 years has increased by 55%. Not bad. So it's been increased a few times. Right now it's $4.40 per share per year when I take up the quarterly dividends and I add them all up. If I take that $4.40 and I divide by my purchase price of $95, my yield on cost is 4.6%. So my yield on the shares that I first purchased back at $95 is 4.6%. Not a bad yield on cost after 5 years. I mean, not huge, but certainly not bad, especially for a company like this where the dividend will keep growing. And so this right here is an interesting case. This is a case where an activist investor came into the mix, shook things up, and it actually ended up working in my favor. And this is not always the case. I'm going to share some examples later in this video where this is not always the case. But I wanted to start out with a bright case, with a positive case, because this video today, it's a reflection of some of the comments that have come up here in the PPCEN community. If you're new to the community, by the way, we are a community of dividend growth investors. We invest for income, for cash flow that can literally pay the bills. That's what we're talking about here on my channel, and other topics as well related to investing. And this question came up. It came up, hey, Ian, what do you think about activist investors? How do you deal with them? Sometimes it's kind of scary when an activist investor comes into the mix. And quite frankly, Ian, a lot of these activist investors, they seem to pop up. They seem to pop up in these dividend stocks, in these value stocks. And it's true. It kind of comes with the territory because when I buy a stock, I try to buy it when it's on sale, when it's a value. And I saw the value back here, and so did Bill Ackman. And quite frankly, if Bill Ackman sees the value that I see, and he's managing a multi-billion-dollar hedge fund, well, it probably confirms that I'm looking at the right things here. I'm finding a company that is, in fact, on sale, that it's a value. But it's also a bit scary because these activists, sometimes they tend to come in, shake things up, and sometimes it's not in the advantage of the long term of a company. It's more of a short-term sighted thing. And so today's video really is about this very topic. It's about diversification and why diversification is so important, so critical, so key. I'm going to talk about how diversification for me mitigates some of these activist investor risks and other risks just with companies getting bought out. And I'm also going to just talk in general about activist investors and the roles that they play, both the pros and the cons, in the types of stocks that I personally own in my dividend stock portfolio. So let's get started. So long introduction today, but I wanted to start with that really exciting example because we all think about these activist investors. And look, when one is a dividend growth investor, to see the results, it takes a long time. I look to invest in companies that I own forever. I want to hold Air Products and Chemicals forever. When Bill Ackman came into the mix, I was concerned. I was like, great, I'm just buying this thing. And what if he just takes it private? What if he finds a buyer that just takes it private? I get a nice short-term capital gain, have to pay the taxes because it's a short-term capital gain at the higher tax rate and as ordinary income, and move on. That's the last thing I want as a dividend investor because I don't want to sell. I don't want the company to get bought out. I just want to hold it forever. And so when an activist investor comes, sometimes it's concerning for a dividend growth investor because the dividend growth investor doesn't really want things to get shaken up too much. They want the companies to sometimes get shaken up from the standpoint that everyone looks critically at the operations, everyone finds a way to improve the company, but they don't want it getting shooken up so much that the company gets taken private and then they have to move on and find another investment. Anyways, this was kind of an example of the best possible outcome where I still have my Air Products and Chemicals, and it's doing really well. My yield on cost is great. The share price is up. Quite frankly, a lot of this is good, but I also have to wonder in the long term, by getting rid of a big percentage of their workforce and getting rid of certain businesses, are those businesses maybe in the short run that were not as profitable, but in the long run would have served the company well? I just don't know. But needless to say, this is an example of an activist investor doing some good and at least the situation turning out in my personal favor. I want to move on now, though, to Heinz Company. I'm not going to go into this in great detail, but I'm going to link in the description below. I did a whole video on this. I used to own a company called Heinz, the famous ketchup company, and I loved this company. Basically what happened is Warren Buffett, 3G Capital came in. Now they're not really considered a quote-unquote activist investor, but I kind of place a lot of these guys in the same bucket. They are big billionaire investors with lots of money that are not really heavy on operations. These are people who typically are not operations, roll up your sleeves kind of people. They are financial engineer kind of people. They have big money and they're looking at a big global game of chess with money. I kind of lump them in the similar bucket. And so Buffett, 3G Capital come in and they're like, hey, we're going to take Heinz private. And so they did that. The premium they paid was not very attractive, in my opinion, to the Heinz shareholders. I don't think they paid a fair price. Somehow this deal got approved. They took it private. I took the money, I redeployed it. But what happened is they paid themselves a bunch of fees, and then they brought Heinz public again through merger with the Kraft company, and now it's the Kraft Heinz company. Anyways, what was the point of that? Is it just to serve the interests of the people in charge who have all the money, who are taking it private, or was it in the best interest of the shareholders? Was it both? I don't know, but just as a dividend investor, someone who relies on cash flow, someone who is investing for cash flow, certainly that's an example of this type of thing not working in my favor. Because like I said, the last thing I want is a company I own to just get taken out. I get a nice short-term bump, but like I said, I just don't care about capital appreciation. I don't care about a short-term bump. I want long-term results, and I want long-term cash flow. Long-term cash flow only comes through yield on cost. And so anyways, for me at least. And so anyways, Heinz, you want to learn more, I'll link in the description below. But that is an example of one of these situations with an activist investor coming in, or investors, and it not really playing out in the favor, in my opinion, of the long-term dividend investors who were invested in Heinz. The point I'm trying to make here is an activist investor can come in, things can work in one's favor or things cannot work in one's favor. It can go either way. And so what I have personally learned, a key lesson, especially when I am going to rely on dividends to pay the bills, and I already have a pretty big amount of dividend income coming in. I can already pay a lot of bills with my dividends, although I choose not to. I'm reinvesting them so that my snowball can get even bigger. And anyways, when I do flip the switch, when I do start paying bills with dividends, the last thing I need is one of my companies like Heinz getting taken out and then having a short-term disruption in dividend income. So then I'll have to find a way to redeploy the capital. Maybe the market is overvalued and there aren't any good values out there. Maybe it's not the best time to redeploy capital. If all of my eggs were in the Heinz basket, that would be kind of troubling when a bill rolls in and I couldn't have enough cash flow in the short run coming in from dividends. I might even have to dig into principal from the Heinz sale, which certainly I wouldn't want to do. Anyways, the way I get around this is I diversify. I own 37 stocks. And so if I have a Heinz in there that gets taken out, Dr. Pepper Snapple is another example. I had some Dr. Pepper Snapple. I love this company. It did phenomenally well for me. I'll link in the description below. I did a whole video about this, actually a few videos. And I was unhappy when it got bought out by private equity. They're going to basically combine it with the Keurig company. They're taking Keurig public again. It's going to be part of Keurig. But anyways, I was unhappy about this because most of the Dr. Pepper deal for Dr. Pepper Snapple shareholders is just a one-time cash special dividend. Again, one would have to redeploy the money into other stocks or into the combined entity, which we don't even know is going to pay dividends. Anyways, these types of things happen, but when I own 37 stocks, it mitigates this. And look, at the end of the day, Heinz getting bought out for a higher price than I bought it, Dr. Pepper Snapple getting bought out for a much, much higher price than I bought it. These are not horrible things. These are not horrible things in the scheme of things, but they just can disrupt income in the short run, especially when one is relying on income. But one can smooth it out. It's just a key lesson I've learned, that I smooth it out through diversification. So I want to move on. This is a very timely video because I just did a video review of United Technologies, ticker symbol UTX, my number 4 favorite dividend stock of all time. I love this company. And I love it because most people aren't talking about it. It's one of the reasons I kind of like it. It just flies below the radar. But it's a big $100+ billion company, really well diversified in the industrial space. Great company. I'll link in the description below to my recent video of UTX. Anyways, I got some really savvy comments here, and one of my buddies messaged me on Twitter and said, "Ian, you got to look at this. Here's an article about it." Basically, there's chatter out there about UTX getting broken up, and I love, though this one's interesting. I love how this came down. The UTX CEO, I think it was in February of this year, February of 2018, came out proactively. This is Greg Hayes. He said, "I'm my own activist. I'm considering all options on the table. If UTX is worth more broken up into several business units, all separate, we will look at that. Our board of directors, our management team, we will look at that and we will take a hard look at that." And what I love about Greg is I don't think he intends for this thing to get broken up. The reason he's putting that out there proactively is he's trying to show the world, show the shareholders that he's his own activist and that they're looking at these opportunities. Does he really want to break up this company and end up being CEO of maybe one of the 4 branches versus being CEO of everything? No. Is it in the best interest of the company to break it up? No. Maybe in the short run it unlocks some quote-unquote value, but in the long run, for people holding this thing for 30 years, does that unlock value? No way. I've worked at a lot of companies, and I know that there's certain business functions like the legal department, the finance department, the HR department, the investor relations department. It's going to be better to have one of those departments and span 4 business units than have 4 separate companies or 3 separate companies and have to duplicate all of those business units for each company. Obviously, there's efficiencies by having one company. But what Greg is doing is he's getting ahead of it. He knows because there's back channels. He knows through the grapevine these activist investors are coming for him. And so he gets ahead of it. And lo and behold, a few months later, I think in March of this year, Dan Loeb from a company called Third Point Capital comes out and says, "Hey, I work at a hedge fund. I've got a lot of money behind me. I'm looking to talk to UTX, and I want to consider breaking things up." And so United Technologies, maybe it gets broken up, maybe it doesn't. I don't think it will, but I just don't know. I guess I shouldn't say I don't think it will. I think it has a good chance. If anything has a good chance of not getting broken up, I think this does, because I think Greg's playing a game of chess here. I think he's being smart about it, and I think he got out proactively before the activist investor came and said, "Hey, Greg, you never considered this." No, he is considering it. He's his own activist. I love how this is playing out. Now, don't get me wrong. I think the activist investors actually play a good role. They keep these companies honest. They keep them on their toes. They certainly, look, as shareholders, we own shares. We're the ones that own these companies. These activists come in and they're pushing these companies to basically fight for their lives. They're pushing companies to fight, to be scrappy, to do everything they can to keep their companies intact, for the fear that these activists come in and just rip everything apart. And so anyways, I actually think they play a good role in the interest of the shareholders, that they keep everyone honest. That being said, for a long-term shareholder like myself, someone who loves dividends and cash flow, needs yield on cost, and is willing to wait 30 years, and quite frankly is willing to have a company that is not unlocking its value. I don't care if UTX doesn't unlock its value for a long time, for like 20 years, because if it's not unlocking its value, that means it's a value. That means I can buy at lower prices. That means I can get a better starting yield, a better yield on cost. And so I look at it so differently than people like Dan, who want to try to unlock the value now and get a short-term gain. And so quite frankly, there's a lot of pros and cons with these activists. They're here to stay. They do some good for these companies, but they also can potentially throw a wrench in the plans of a long-term dividend investor. Now, the thing about United Tech that I want to point out is this is different. Air Products and Chemicals, there is a huge risk here because this is a smaller company. When I bought it in the plus or minus like $20 billion market cap range, now they're up at like 30 billion, somewhere in that range. That's a smaller company. In the scheme of things, someone could just take the whole thing private, just like they did with Dr. Pepper Snapple. I hate that kind of thing. And so this played out in my favor. Heinz, again, smaller. I think when I owned it, it was like 20 billion, something like in that kind of range market cap, just got taken private. These are more risky when an activist comes to play. United Tech, this is a $100 billion company. Is the whole company going to get taken private? No. Could parts of it get taken private? Yes. Would it disrupt my dividend? Would it disrupt the long term? Probably not. It would probably be more like an APD type of situation. The beauty of a bigger company like UTX is maybe they break it up, then I'll just own a few different publicly traded companies. Hopefully they continue to pay the dividends and they continue to grow the dividends. That's where I'd have to keep just a laser focus to make sure that that's the case. But that's something worth pointing out, that the bigger the company, the less the risk of the activist, in my opinion, because the activist just isn't going to take the whole thing private, or isn't going to mess the thing up so bad when that is possibly the case when it is a smaller company. And so certainly I like to diversify my portfolio with small companies in terms of market cap, medium, and large. I tend to skew larger, but I like having representation small and medium. I just realized small and medium, they're more at risk of an activist or someone else coming in and taking it private or doing something kind of wacky. I want to take another example here, Procter Gamble. So this is a company that I talk a lot about here on PPCE, and I'll link below. It's one of my favorite stocks I'm buying in 2018. I feel like it's on sale right now. And again, I'm buying it right now, and I'm buying UTX. The fact that Dan Loeb is coming in and saying he wants to buy UTX, wants to consider breaking it up, that confirms everything. It confirms I'm finding value, that I'm doing the right thing. So that's a good thing. It's confirming. Same here with Procter & Gamble. Nelson Peltz from Tryon Capital, another hedge fund, he comes in, he says, this guy actually got a board seat. And this is what's crazy. They did this big proxy battle, proxy vote. He didn't even win the proxy vote. He slightly lost. They still gave him a board seat because I think nearly half of the votes wanted him. And I think they felt like there might be a backlash from Procter & Gamble shareholders if they didn't give him a board seat, because enough people wanted it. Who are these people that want it? Probably people that are really short-term focused, not looking 30 years out. They're looking now. Anyways, he got a board seat. He's going to come in and he's going to shake things up. Who knows what happens at Procter & Gamble, but this is a company with a market cap over 200 billion. This company, it's not going to get taken private. Maybe it'll get broken up. Maybe some business units will get sold off. I don't think he can rock the boat that much, though. Just given the scale of this thing, they're not going to have no more Procter & Gamble, in my opinion. Maybe I'm wrong, but I just see, similar to UTX, the company gets bigger, the less risk of this kind of thing. But he does now have a board seat. We'll see what happens. Does it dissuade me from buying more Procter & Gamble? No. Here's the thing. It's hard enough being a value investor, being a dividend investor. I have to find a stock that's on sale. I have to find a stock that's going to be around for the long run, real long run. I'm talking generations. I buy these to never sell. I have to find a company that I love, that I understand, that I can stand behind, that I'm passionate about. I have to analyze all of the fundamentals and find a company that has competitive advantages. I have to find a company that is going to reward me as a shareholder with increasing dividends. When all the stars align, I personally don't make this kind of thing a checklist. Like if there's an activist investor involved or not, I don't look at it. I don't care. I mean, I look at it, I know about it, but I don't care. It doesn't dissuade me from buying. Because I could have, back when I started with APD, said, okay, Bill Ackman's involved, I'm out. No, I actually kept adding to my position and stayed strong on that position. Same with Procter Gamble. Nelson Peltz is involved, I'm buying right now. With United Tech, Dan Loeb is involved, I'm buying this right now. I'm actively buying United Tech. And so the fact of the matter is, and this was the specific question from some subscribers. They were asking, Ian, what do you do when these guys are involved? Do you not buy? Do you buy? I don't look at it. I keep buying because it could work out anyway. I don't know how it's going to work out. I think there's pros and cons with these guys, but I just don't let them get me nervous about the positions that I love so much, because I tend to believe with my diversification strategy, it will all work its way out. Now, if I had only one stock, that might be a little bit more concerning, especially if it were a smaller one and there was someone looking to rock the boat quite a bit. Maybe that would change things a bit, but because I'm diversified, I don't pay too much attention to letting these guys dictate how I invest. In fact, if they are invested in the companies I'm in, it means I am finding value. So a few takeaways. We talked about this. It comes with the territory. If you're a value investor, if you're a dividend investor, this will probably happen to you at one point or another. Probably, if you own 37 stocks like me, happen all the time. Comes with the territory. One needs to get used to it. So lesson number 2 is diversify. If I owned only 5 stocks and one of them was Dr. Pepper Snapple, it got taken out, I had to redeploy the capital, to me that would be a little more concerning than my situation now where I own 37 stocks and it's just one drop in the bucket. I can work it out, and I can work it out on my own time. I can think about it. I'm not in a rush. I can just figure out, and I did redeploy my Dr. Pepper gains and I really enjoyed doing that. I think it actually worked out for the best, but just having that diversification, it really put my mind at ease. And so that's a key lesson here, that this is part of the territory. Because it's part of the territory, it's really important to diversify, in my personal opinion. Third takeaway is big companies have less risk of this than small companies. There's going to be activists with big companies like Procter Gamble and UTX, but I just don't see them having the ability to do something like was done with Heinz, getting completely taken out, or Dr. Pepper Snapple. They're just too big. And so they may get split up. There may be business units sold. But in general, there's activists involved with these. But I personally, it just doesn't worry me as much with big companies. So a few more takeaways that I didn't list here. I think takeaway 4 is when an activist is involved, it's generally a good thing. It confirms that I'm buying value. I like that. So that's lesson 4. Lesson 5 actually is the activists are not all bad. I personally respect people with a business operations background and the people running the companies to make the right decisions. And so I don't like it when an activist comes in, and I look at these activists, oftentimes hedge funds, as short-term. They're just looking at the short-term gain. In fact, with Air Products and Chemicals, Bill Ackman, he sold his position recently in 2017. He's now out of it. So it's kind of short-term to me, 5-year period. Get in, get out. Not that short though, but still an activist is more short. It's certainly not 30 years or 50 years or 100 years kind of time frames like I look at. But anyways, they do play a role, and they come in and they keep the management team honest. So I don't look at them as all bad. I think there's pros and cons, as with anything in life. So before I leave today, because this is about diversification, because all of these examples really point towards one thing, diversification, I just want to take an example here. I've got some money here, and there's different ways that one could diversify. I want to just show an illustration of how I like to diversify. So one could just put everything in one stock. Let's say there's $20 total, one stock. The problem with that is if one owns one stock, all $20 in one stock, and it's, let's say, Heinz, and it gets taken out, that can kind of disrupt in the short run one's portfolio, one's entire strategy. So instead of doing that, one can go the polar opposite, and I'm not going to count them here, but I've got 20 ones. One could just pick 20 positions, divide the money up amongst 20 positions. And that's generally the type of strategy that I've taken. I've gotten really, really well diversified. But there's kind of things in the middle. There's strategies in the middle as well. And so one of those strategies, for example, is let's get rid of like 5 of these ones. And let's say there's just a pillar position, like UTX, for example. I love that company. Let's say I want to put $5 in UTX, and then I want to split the other 15. I took 5 out of here amongst 15 other stocks. That's another way to diversify. And what I'm trying to show here is when one diversifies, one doesn't have to have the same amount of money in each stock. One can weight it, skew it towards their favorite holdings. And that's what I do. I have what's called core stocks. And my core stocks, like UTX and my other core stocks, I'll link in the description below. I have a bunch of them I've reviewed here. I like to weight heavily in them. And so, in fact, what I probably have done, not just like this, I have 37 stocks, so this isn't the right amount of money here, but I'll take out another 5. Just for illustration, the kind of thing I've done is more like this. I'll have a $5 stock, I'll have a $5 stock, and then I'll do maybe 10 split amongst $1 in 10 other stocks. And so I do that kind of thing, where I skew it heavy towards my core holdings that I love, like UTX, and then the medium and smaller holdings, I kind of spread the money out amongst many stocks, little bit in each of them. And one doesn't want to diversify. One does not want to diversify so much that it's hard to keep tabs on things. I always like to have at least 1% of my portfolio value at a minimum in a stock. If a stock has less than 1% of my money in it, I will quickly add more money to bring it to size. It's just not meaningful if it's lower than 1%, but I am certainly not the person that puts all the money in one thing. And I'm certainly not the person that might go ahead and put the money in 3 things, unless my portfolio was just getting started or is smaller. But given the scale of my portfolio, I'm the guy that takes positions in 37 stocks, and this is one of the fundamental reasons why. Thank you for hanging in there today in today's video. I hope you enjoyed it. I really, really am thankful for the subscriber question. I want to thank you. I want to thank everyone who asked this question. It's a brilliant question. I hadn't thought of even covering this topic until I got these questions from the community. So I am thankful and blessed to have the amazing community here. If you enjoyed the video, please give me a like, a thumbs up, a subscription, a comment. All of that means the world to me. And if you have a question, put it below in the comments, because I am actively looking to those, responding to those, and many of them become videos like this one. Before I leave today, I want to add a disclosure. I am long. I own in my portfolio the stocks covered today. I own Air Products and Chemicals, ticker symbol APD. I own United Technologies, ticker symbol UTX, and I own Procter Gamble, ticker symbol PG. I own those stocks in my portfolio. Also, as a friendly disclaimer, I am not a licensed investment advisor. Today's video is not investment advice. It's just for your fun and entertainment. If you're going to go out and invest money in the stock market or anywhere else, please consult a licensed financial advisor first. Hey, what do you think? What is your diversification strategy? Do you like to diversify? Do you not like to diversify? What do you think about these guys, the activists? Are you as nice to them as I am? Or do you dislike them? Do you like them? I would love to hear your opinion. I think we'll get some lively discussion on that. Just put it in the comments below. Thank you so much for watching, and I will see you in the next dividend investing video.